that's really the whole thing. But there's the disclaimer. Take about 15, 20 seconds, read it over really quick, and then I'll introduce our next speaker. All right, guys. Our next speaker is going to have a really cool talk. It's called Trend Following and Trend Lines, how to trade and invest like the hedge funds, AKA the smart money that we're always hearing about out there, right? Well, his name is Dan Sugar, and Dan Sugar comes to us from trendlinebreak.com. And Dan is not a first generation trader, not a second generation trader, but a third generation trader. So his entire family has been trading, and that knowledge kind of drops down from the knowledge tree. Dan started trading in 1998 on the CBOT floor, specializing in soybean options, transitioning to screen-based trading in 1996, and became a licensed futures broker. Dan's passionate about educating and mentoring, starting with his own educational service and website to teach aspiring traders just like you. Now, Dan emphasizes mechanical risk management to remove emotions from trading, and he focuses on helping his students develop their own trading style and their own personal plan. He prioritizes risk management, which Rodrigo talked about earlier, probabilities, and balancing risk versus reward in every trade. Dan Sugar is here. Dan, how are you today?
I'm doing great, John and Rod. Thank you so much.
It's a pleasure.
We appreciate you donating some of your time for us and educating the masses today. We really appreciate it.
Oh, I really enjoy doing these. I've done a couple, but this is my first one with Summer Market Summit, so I'm looking forward to a great session. And the pressure's on to end at 10:59 and 45 seconds.
Well, we ran a little long because we were kind of going over, so you don't have quite the same pressure. He started exactly at 8 o'clock, so I was just like, when he wrapped it up, I was like, oh wow, that is right on point. Like, it's usually a couple minutes one way or the other, but take your time, please. And when it comes to the chat, the questions, don't feel rushed. We want you to give as much information as you can, and we're going to turn off our cameras, mute ourselves, and it's all up to you now.
I'm going to go ahead and share my screen. Awesome. Thank you, guys.
Sure.
You guys can see my screen, correct?
Yes, sir. We can see it.
Audio's coming in clear. I can move my mic a little closer if the audio's not so good, but it's pretty good so far.
I think it's pretty good. Rodrigo, I think it's pretty good for me, right?
Yeah. Loud and clear, Dan. So awesome. The floor is yours. Good luck.
Thank you, guys. Yeah, I got a good microphone, so it usually works pretty well. So, yeah, good morning, everybody. My name is Daniel Sugar, and as John was saying, third generation, actually, Chicago floor trader. He forgot to mention it was a floor trader. So my grandfather was at the Chicago Butter and Egg Board, which eventually became the Chicago Mercantile Exchange, but he was trading butter and eggs in the early 1900s. Before there was soybeans and bonds and S&P futures, there was butter and eggs. So he was that. I'm the youngest of four, and my dad's the youngest of five. So my grandfather passed about 5 years before I was born. But then my dad was my dad went to a couple years of college, then went to the Navy in Seattle area, and then went to the Board of Trade in 1950, January of 1950, and spent 35 years there. So when I take that 23andMe DNA test, my chromosomes were XYT. So T's for traders, a little joke there. So anyway, but no, I love sharing my knowledge. I've done several of these, and it's we're gonna have a great session. So please definitely get a pad and some paper, legal pad or some copy paper, or take some screenshots. We're gonna go over some really good information, I think, for an hour or 45 minutes, and then I got about a 34 page PowerPoint presentation, and then in the last 10-15 minutes we'll dive right into charts and apply what we just learned about how to identify the macro trend, how to draw trend lines accurately. I did spend 3 years with a very successful hedge fund trader. He worked for JP Morgan on the currency desk for 10 years, but then he always dreamed about opening up a hedge fund. So he opened up a hedge fund in 1997 with $1 million. And then 10 years later, it was $1 billion. He took $1 million hedge fund to $1 billion in 10 years, retired at 44 years old. And then him and his two partners opened up a proprietary trading floor in Boca Raton, Florida. And then I was in the very first class, by the way. And then it got so big after 3 or 4 months, they moved to a bigger office in Delray. So I got to trade with and learn from a very successful hedge fund trader. And that's who taught me this trend line and trend following. And he was a classical technical analysis guy. He did candles, he liked bar charts, trend following, trend lines, and some patterns, as Vince was mentioning. So let's dive right in. A little risk disclosure document and risk disclaimer. And I always say to students, if you don't manage risk, you're not going to have any risk to manage. I do see a couple attendees that are familiar with my education. Doc, Andrew over in Scottsdale, and a few other names I do recognize. So great to see everybody. And I've been putting this stuff on Twitter and Facebook and all kinds of stuff. So great to see everybody that's been familiar with me. If you're not, you might, if you're familiar with me, please laugh at any jokes, even though you've heard them 3 or 4 times, or be on the edge of your seat for any stories that you may have heard 4 or 5 times already. But for you new folks, we'll try to keep it light and have a great session. So, yeah, my little ethos and tagline is integrity, transparency, and performance. Who am I? A couple seconds again, 3rd generation. And that's my little bio, my mugshot from my probation days. So there's a picture of some old trading cards when I was 18 and the Mid-Am Exchange. Right next to the Board of Trade, there was a Mid-America Exchange. It was like the minor leagues. The soybean contracts and corn and wheat were 1/5 the size of the neighbor at the Board of Trade. So this is like the first E-minis, actually. The bond contract, T-bonds, was 1/2 the size of the Board of Trade bonds. So it was called the Mid-American Exchange. And I was a runner there for the summer of 1982, my senior year of high school, learning to trade Mid-Am bonds outside the pit when it was slow. And if you notice, bonds right now are like, what, 125 or so. Back in 82, bonds price were at 60. So interest rates were 12.5, 14, 15%. Those of you that had a mortgage back in the early 80s know exactly what I'm talking about. I didn't have a mortgage because I was only 18, but mortgages were, 15, 16%. So we just went from about 3% to 7 or 6.5 now, but mortgages were very expensive back in the early 80s. But there's my trading card. So if at first you don't succeed, try doing what your instructor told you to do the first time, right? Mentoring is so important. I love sitting on some of these web classes myself with other instructors, other mentors. And if I can pick up 1 or 2 things or to re-enlighten me about a few things, I always enjoy doing that. And I caught the last 20 minutes of Vince's presentation. I like the higher timeframes like Vince. I like the patterns like Vince was talking about. And I'm a big trend follower like Vince was talking about. I think that was a nice little moving average and big trend followers. So those are very, very good to hear. I got a couple 3 quick PDFs here. Here's a guy that's on trial. He says, "Don't worry, I've watched a lot of Law and Order." As his defendant turns around, looks at his attorney. So that's kind of funny. Sometimes I do these web classes and summits, and I'm like at 4 o'clock or 5 o'clock. So students have already watched like 4 or 5. So I open up these 3 quick jokes to make it a little light. So here's an aviation pilot. I've just finished a YouTube video on 747s. Buckle your seats. We'll be taking off shortly, right? And then here's a person under the knife and getting some surgery, looking into a surgeon's eyes. Of course, I can remove your blood clot. I've got Wikipedia. The point is, no matter how many seminars you attend or books you read or YouTube videos you watch, you got to get some quality education somewhere. You got to spend some money, spend some time, and get some quality education from a mentor, from a coach that's been through the trenches, that's very knowledgeable. Do your due diligence, etc. So here's my little ebook. My specialty is trend following and trend lines. It's been around for over 100 years. We're going to talk about the history of them in a little bit, but I did write an ebook about almost a year ago, and very proud of that. Put my heart and soul into my little ebook there. So our web class is going to be how to identify the macro trend. You've heard, the trend is your friend until the bend at the end. Well, the bend at the end is the trend line break, right? And that's my website, trendlinebreak.com. But the trend is your friend until the bend at the end. And yesterday in the NASDAQ, NASDAQ and QQQs have been going parabolic with the momentum and the hype all around AI. I'm sure you've been hearing about it, unless you're living in a cave or under a rock. But AI has been the rage. But we've had a nice rally in technology. And yesterday there's a rotation out of technology into small cap. Russell was up like 1.5 or 2% IWM, and Russell futures of the NASDAQ got hit pretty hard, but it's had a nice parabolic rally, and NVIDIA and all the FANGs have been doing really well. So, but we had a trend line break on the NASDAQ futures daily chart. So we'll show you that momentarily. So if you've been around trading for a while, investing, folks, you've heard the name John J. Murphy. He's been around for 40 years or so. He wrote a couple great books in the 70s, techno analysis of the financial markets and intermarket techno analysis. He started stockcharts.com. So he says in his books, the trend line is perhaps the simplest and most valuable tool available to the chartist/trader. Simplest and most valuable. That's pretty powerful. And this is from John Murphy. And then the second bullet point, the violation of a trend line is often the best warning of a change in trend from bullish to bearish, or a downtrend that gets violated to the upside from bearish back to bullish. Now, again, they don't all work. Nothing does. If somebody tells you, their strategy works 97.9% of the time, run the other way. But as John was alluding to, you can have a methodology or strategy that's wrong half the time, or even a little bit more. You can be wrong 40% of the time or 35% of the time, as long as you cut your losses and let your winners run, or cut your losers, let your profits run. Strict risk management. And then on some of your winners, you got to have a 5-1 or 6-1 or 7-1 risk reward setup and ratio, and let those winners run. We used to say on the floor, you don't want to eat like a bird and poop like an elephant. Excuse my French, but it's got a lot of important stuff in that saying. So your methodology, whatever you're using, it has to generate some 5 and 6 and 7-1 risk reward opportunities. So you got to know the math. But some people get so emotional about the trade that they're currently in. It's got to be a winner. The last 3 trades were small losses, and now you're in your 4th trade, and you're having too much fear and greed, etc. You got to stay calm, manage that fear and greed. The edge starts in your head, so positive psychology is very, very important. But you got to let some winners run, definitely. So again, this is from John Murphy, and you can use MACD or stochastics or RSI or Fibonacci, but a lot of people use those as a secondary confirming signal. I think you need something, elementary and easy and that works. And trend lines and trend following has been around for 100 years. Institutions use them, hedge fund traders use them a lot. If you tour Stamford, Connecticut, or New York, now more, it's West Palm Beach and Miami, they're all moving to Florida, hedge funds, because of a lot of certain things. But if you take a tour of a hedge fund office or a trading desk, institutional trading desk, you will see a lot of trend lines on Bloomberg terminals, etc. And that's where I learned them. I mean, I knew about trend lines, but I really learned them from that 3 years from 2010 to 2013. So I hope your charts don't look like this, because this is a hodgepodge. And, I think a lot of traders make trading more difficult than it really needs to be. Successful trading is kind of boring, actually. I mean, if you're into the excitement and gambling, you're in it for the wrong reasons. But I like clean charts. You won't see any indicators on my charts. I do use moving averages. That's the only indicator I use. For me, it's all about trend following, patterns, candles, and trend lines, and some volume. But I do use some moving averages, because moving averages are called dynamic trend lines. Moving averages are called dynamic trend lines. My trend lines are rigid. I know how to draw them accurately, and then moving averages are moving average. So, but sometimes you can get some nice crossovers, and they are lagging a little bit by 1 or 2 or 3 or 4 candles. But those are the only indicators you'll see on my charts. Yeah, simplicity is the ultimate sophistication. I love that. Yep. Doc is in the house. So keep your charts clean, folks. Too many things. I actually got this from a presenter one day. I mean, I'm not going to reveal who it was, but I was on something, and this was his slide. I'm like, oh my God, where do you buy or sell on that stuff? So here's my charts. Here's the QQQ a little while ago, but just some institutional level supply and demand zones and trend lines. One thing I will say, folks, that's really important, that's I think underestimated, is price has memory. What do I mean by that? Price has memory, meaning old highs and lows are very, very important. Prior turning points become future turning points many, many times, give or take a couple ticks or a nickel or a dime on a stock. But that's what forms double bottoms and double tops. They don't all work. Nothing does, but they work a lot, and trend following and patterns generate a lot of low risk, above average reward, and above average probability opportunities. And that's what you're looking for. You're always looking for low risk, above average reward, above average probability. I've heard some, traders talk about they risk $300 to make 100. Like their risk reward ratio is inverted, and that's crazy to me. I mean, you got to be right, 75, 80% of the time to make money like that. So I like to risk 250 or 400 to make 1,200, 3-to-1, or more, obviously. But risk reward ratio is very, very important. If I take this trade and I'm risking 300, do I think I can make 900 off this chart pattern or this trend line or this wedge or this bear flag? You always want to ask yourself that, right? So keep your charts nice and clean and keep it simple, students. I like the KISS method. Keep it simple, students. You thought I was going somewhere else with that, but all right. So here's 5 things that I think are very, very important for successful traders. Some of you have been investing in trading for a decade or two. Some of you are under 3 months of live money. Everyone's at a different spot in their career. But number 1, numero uno, I'm bilingual. You need a proven strategy with an edge and the discipline to follow it. Okay. You got to have a proven strategy with an edge, back tested, as Vince was saying, he was in front of the screen for many, many years and 4 hours a day, get in front of that. And I like what he said about training the eyes. I've been in front of I left the floor in March of 1996 and became a retail futures broker for 10 years, 96 to 05. So I spent my 10,000 hours or more in front of the screen, and you see things, you start to see patterns and certain things jump out at you after being in front for all these years. And you got to put in the time. Number 2, risk management. If you don't manage risk, you're not going to have any risk to manage. Small losing trades are okay. Cost of doing business. Think of your trading business. Think of your trading as a business, and all businesses has revenues and expenses, right? Your revenues are your profits. Your losses are your expenses. And all businesses need to keep expenses to a minimum. And so no big losers. Some of you have been through that already and experienced that, but no big losses. Love your little losers. It's all about risk management. You're going to be wrong. You're going to be wrong 50% of the time, 40% of the time, 65% of the time. You're going to have 3 or 4 losers in a row. Keep them small. You can bounce back from 3 or 4 small losses. It's tough to bounce back financially, or more importantly, psychologically, from large losses. So always put your stop in. Put that stop in. If this trade goes against me, where am I getting out? Right? Always ask yourself that. And the beauty of trend lines and patterns, you know where you're wrong, right? Once you know how to implement them, you know where you're wrong. So I always tell students, why would I risk $600 on a Microsoft trade if I know I'm wrong 350 for my entry? Or why would I risk $400 on crude oil futures if I know I'm wrong at 250? Doesn't make any sense. So you know where you're wrong, and no matter what methodology you use, you always want to know where you're wrong, and that's where your stop goes. Number 3, proper position sizing. Don't trade too large, even if you got a $250,000 IRA or a $100,000 account. Don't be shooting 10 E-minis. Start with micros, baby steps. So position sizing is very, very important, extremely important. Trade small, grow tall. You can make good money in futures doing 1 and 2 contracts, or 2, 3, 4 micros, or 50 shares or 100 shares of stock, or Forex trading small. Number 4, understanding of probabilities and the risk reward relationship. Successful trading is a game of probabilities. It's if you're a good 7-card blackjack player, 7-card poker player, Texas Hold'em, or a good blackjack player, it's not going to hurt you. Understanding probabilities is very, very important, and that's all it is really probabilities. And then again, balancing risk reward. If I risk X amount, can I make Y on this trade? Don't take 1-to-1 trades. That's just not a good proposition. And then number 5, once you have your strategy, you got the knowledge, you know your platform, whether it's Thinkorswim, TradeStation, Interactive Brokers, Robinhood, whoever. Once you know that, and you know how to place orders and trailing stops, and again, you know your strategy in and out, then it's all about psychology. Can you handle fear and greed? Can you stick to your plan? Can you get unemotional? And one thing I learned from the hedge fund manager, the word that he always used was be detached. Be detached. Don't be so wrapped up in the current trade. It's just, this trade's going to be one of several trades you're going to be in that day, that week, or so don't get so wrapped up over one trade. Don't have outcome bias, right? So sound psychology and solid mindset, super, super important. Here's my little Venn diagram. So you got to have your trading method, your trading psychology and risk management, and then that's your trading edge. Your knowledge, risk management, stops on every trade, your strategy that's been back tested, and a proper mindset. Not easy to do, it takes time, but once you can balance all three and really stay focused and stick to your plan, the sky's the limit. Here's a quick little math again. If you lose 10% in a month or a week, you got to get back 11% to get back to break even. If you lose 30%, you got to make about 43% just to get back to break even before even thinking about sniffing a profit. You lose 50% of your account. So if your account goes from 10 grand to 5 grand in a quarter, you got to double it just to get back to 10 grand. You know the math. So risk management, love those little losers. And then you got the little muscle guy like this, my little dollar sign with the pipes. All right, here's one more little thing, just to kind of gauge where you're at. $50 a day is 12,000. 600 a year, a little hobby. $100 a day if you can average. Some days you'll have small losses. Some days you'll make 250. But if you can average $100 a day with your day trading or swing trading or position trading, nice little side hustle. If you can, average 250 a day, it's about 63 grand a year. That's a job. And then 500 a day, etc. There's your career. And then 1,000 a day, then you can say, bye-bye, boss. I'm going to go do my own thing. But, the reward's there, the upside's there. You got to put in the time, put in the, screen time, get some education, and put it all together. It takes time. So some things you're going to learn today: understand how powerful the macro long-term trends are. Be able to look at a chart quickly and confidently discern if there's a trend, up, down, or sideways trading range. Realize the power of buying pullbacks and retracements during uptrends and selling strength and rallies during downtrends, right? We've been in a downtrend since, January of 2021, right? 2022, excuse me, year and a half now. Yeah, January 2022. Again, we've had a nice run. Is this a bear market rally, or is the bear market over and the bull market's definitely already started? So, we got higher interest rates. We got some headwinds with the Fed. One of my things I always tell students, don't fight the Fed is a famous quote from Marty Zweig, who's been around for a long time. Well, he's passed away, but he was on Wall Street Week in the 70s and 80s with Louis Rukeyser. I used to watch that in Chicago with my dad, Wall Street Week. But Marty Zweig was a legend on Wall Street. He used to say, don't fight the Fed, well before Alan Greenspan. But he meant when the Fed is in a dovish mode with free money and, cheap money and low rates, the stock market loves that. Buy pullbacks and find reasons to get long. Conversely, when they're hawkish, like they've been, and they've been announcing that for 18 months, we're raising rates. I mean, they did 0.5 point and 0.75 point multiple times. So they're telegraphing, we're going to make money tight. And the punch bowl is being taken away, folks. So you got to watch the bond market. If you trade stocks or you're an investor, whether you're a day trader, swing trader, position trader, those are 3 different styles, or investor, you got to watch either TLT or bond futures or T-note futures, interest rates. Super important. Yeah, I think they're recording these, right? So yeah, you guys can have access to the recordings. And again, we're going at a good pace, but you can stop and start them. And I'm pretty sure they're making those available. Absolutely. But keep an eye on the bond market, folks. Very, very important. And right now, bonds are trending down. It means rates are going up. I mean, if you look at the daily bond chart, there was like 3 weeks of red, 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 red. So we'll take a look at that in a minute. Identifying high probability locations where to buy long and sell short, support or demand, or resistance supply. Those are used interchangeably. Support, demand, resistance, supply. Again, risk management, position sizing, and psychology. So here's a little slide about the history. So again, when I put together my ebook, I did my due diligence, did some research, and got some good white papers in history. So David Ricardo was a London stock and bond trader in 1790 to 1818. He made a fortune. He's credited with saying, cut short your losses, let your profits run on. And then they kind of changed a little bit, but that's been around for a long time. Arthur Cutten, a legend and Chicago grain trader, CBOT, early 1900s, stay with the trend. Another way of saying, letting your profits run. Jesse Livermore from Reminiscence of a Stock Operator, sizing up the market and its trend, right? I hate the 5-minute chart. I lost, several $1,000s learning to hate the 5-minute chart. It's way too emotional, way too whippy. So I don't like the 5-minute chart. So I'm not saying you can't make money on a day trading on a 5-minute, but it's just a lot of whip and a lot of motion. So Charles Dow and the Dow theory, he worked for Wall Street Journal, wrote a series of articles in 1899 to 1902 about bull and bear markets and trend following. 120 plus years ago, folks, trend following in 1899 to 1902. Ralph Nelson Elliott Wave, expanded on Dow theory. Richard Schabacker, technical analysis in the stock market profits in 1932, wrote about trend following. Harold Gartley, profits in stock market in 1935, wrote about trading with the trend. And then some of you that have been around the markets for a while, Edwards and McGee, technical analysis of stock trends in 1948. I have the PDF and the hard copy, read it a couple times. They talk about trend following. Markets tend to trend. Richard Dennis and his famous Chicago Turtle Traders used Donchian channels in the 70s, and those are trend channels. If you haven't heard of the Richard Dennis Chicago Turtle story, definitely Google it and learn about it. Basically, him and his partner had an argument, kind of like Trading Places with Eddie Murphy and Dan Aykroyd, but they argued about, are successful traders born, or can you teach somebody a methodology and can they make money with it? And they found that the good news is for everybody here, you can teach somebody a methodology, and as long as they stay within the rails and follow it, they can make money. But some people screw things up because they get, emotional and other things come into their thought process. So out of the 13 turtle traders, the 3 or 4 top successful ones followed the trend following strategy that they were taught to the T. No second guessing, right? But anyway, if you're not familiar with it, Google Richard Dennis, Chicago Turtle Traders. My father actually filled orders for Richard Dennis. My father and his partner were the largest soybean spread brokers in the 70s. And the 70s grain markets was like the NASDAQ in 1999. And 7 or 8 out of 10 years in the 70s, the grain markets were going ballistic. Corn, wheat, and beans. So anyway, Richard Dennis was a trader that would go around to different pits, whatever was hot. If the bonds were moving, he'd go to the bonds. If the corn was moving, he'd go to corn. If the cattle was moving, he'd go over to the Merc and go to the trade cattle. If gold was moving, like in 1980, 800, he'd go to New York. But my dad and most traders would spend all day in one pit. And then there are a few guys that would go around to different pits depending on what was moving and where the opportunities were. But anyway, great story. And then several of them also made major contributions in chart patterns, bull and bear flags, pennants, wedges, and triangles. Okay, a little history. Know your history. Here's another last quote from John Murphy. Charts are used primarily to monitor trends. 2 basic premises of chart analysis are that markets trend and that trends tend to persist. Trends tend to perpetuate. Trend analysis is really what chart analysis is all about. Trends are characterized by a series of peaks and troughs. An uptrend is a series of rising peaks and troughs, higher highs and higher lows. Simple definition. Don't make it more complicated. A downtrend shows descending peaks and troughs, also known as lower highs and lower lows. Finally, trends are usually classified into 3 categories: major, secondary, and minor. A major trend lasts for more than a year, secondary 1 to 3 months, and minor, a couple hours or a couple of weeks. I like to talk about macro and micro. Instead of 3, I like to do 2, my little addition, but I like the macro trend is, weeks and months or years. And then the micro trend is hours to, a couple of days. But again, this is John Murphy. Okay. Because trending markets offer the best profit opportunities, one of the most basic goals of chart analysis is to define and identify price trends so we can analyze and join them, right? The trend is your friend. And then we talked about until the bend at the end, hashtag TLB. Here's the definition of an uptrend: higher swing lows and higher swing highs. The buyers are in control. Some people call them swing highs and lows. Some people call them pivots. Again, those are used interchangeably, folks. pivots and swings. And you should be able to look at a chart and the pivots and swings should just jump out at you. It's where the market turned. Where'd the market stop going up and turn back down? Where'd the market stop going down and turn back up? Right? I know there's a couple of them, but you want to look at the major ones, and I like the intermediate higher time frames. So you should be able to look at a chart and be able to see that. And then I like to actually draw the trend line because technical analysis is very visual. Definite downtrend, lower swing highs and lower swing lows, lower pivots, lower pivot highs, lower pivot lows, same thing. The sellers are in control. Trends tend to persist and perpetuate. A trend in motion tends to stay in motion. You guys didn't realize you're going to learn some biology or chemistry today. All right, I know it's physics, just making sure you're paying attention. I was so broke in college, I couldn't pay attention. I was so broke in college, I couldn't even spend the night. I hear you laughing out there. I can hear it coming through my fiber optic internet lines. All right, here's a couple trend lines. This is the E-mini S&P on a daily, I believe, daily chart. Yeah, so here's a couple trend lines. I don't have the time scale on the bottom of it, but that was the pandemic here for like 4 or 5 days. We broke a daily trend line during the pandemic, and then bam, right back up. And there's the little trend line break. The bullishness ended right there where my cursor is. You can see that like the bulls lost their mojo and the bears took over right there. Nice little drop, little pullback, tweezer tops, two wicks and tails back to back are called tweezer tops. Another drop, a little dead cat bounce sucker rally that stopped right near the old highs. Took it out by 3 points or 5 points or something. Double top, and then down, another sucker rally, down, and so on. So trend lines. Here's the QQQ on a daily. Again, there's the pandemic. 4 or 5 days in a row, red. Here's one, this first one, folks, we gap down below a trend line. When you gap down, that's a big, data point. But when you gap down below an uptrend line, sell, sell, sell. Or conversely, if you gap up above a downtrend line, same thing. So gaps are powerful. Gaps are big shifts in the supply-demand equation. So watch for those gaps. You can get a trend line break without a gap, but when you get a gap above or below a daily trend line, very powerful. Here's a small one that only worked for 1% or whatever, small one. But here's a longer term trend, and then there's where it ended right there. There's where the bull market ended, and the bears took over right here, January 2022. And there's some more. We got above a downtrend line over here, back up. We got below an uptrend line, back down. Here we have a little bit of a wedge, lower highs, higher lows. The market gets tighter and tighter and squeezed, and then you get that inertial breakout. And then finally, there's the trend line break over here. The rule is 3 touches. 3 touches is, you have a trend when you get that third touch. We have a trend when you get that third touch. So here's some really good information, folks. You can use trend lines and patterns for any trading style, whether you're a day trader, whether you're a swing trader. And if you're not sure about, day trading is making trades throughout the day. You're done by 3 or 4 o'clock, no exposure overnight. Swing trading, you're holding a trade in Microsoft or the euro currency or crypto or crude oil, whatever, for 2 days to maybe 2 weeks. Position trading, you're holding it for maybe a month to 3 or 4 months, options or stock, ETFs. So it's all about your duration. And then of course you have investing. So there's 4 styles: intraday, swing, position, and investing. And you can use trend lines for any of the above. And the other good news, you can apply it to any asset class. You can draw trend lines on Forex. If you trade options, you got to trade the options based off the stock, because options are a derivative of the stock. So you got to understand the trend following and trend lines of the stock. And then if you get a trend line break to the downside, you can put on some bearish strategies, buying puts, selling calls, etc. If you get a downtrend line that's violated to the upside, I'm using my arms as trend lines. If you have a downtrend line and you get above it, you can buy some calls or sell some puts to pay for your calls, or, for you options traders, you can trade options off trend lines. And of course, Forex, futures, Forex, any asset class that has charting and some volume that's liquid, which means there's a tight spread between the bid offer. Lumber is not that liquid. Propane futures are not that liquid. You got a wide spread between the bid offer. You can't trade that type of stuff, but trade a liquid market. So here's one of the legendary Richard Dennis turtle traders. Several of them went on to be successful hedge fund traders and hedge fund managers. Michael Covell is this gentleman. He wrote, what is trend trading? What type of strategy exactly is trend trading or trend following? Trend followers use reactive technical analysis. Instead of trying to predict a market direction, their strategy is to react to the market's movements whenever they occur. Price action. This enables them to focus on the market's actual moves and not get emotionally involved with trying to predict direction or duration, right? Let the candles be your light. Let the trend line and the trend be your guide, right? Don't try to be a predictor. Good traders react to price action, then try to predict it. Okay, so that's a very important quote from, again, Michael Covell. He's written several books on trend following. One major tenet of technical analysis is that prices of equities and stocks and ETFs and currencies and futures, they move in trends. Markets do not jump up and down in a random fashion. On the contrary, they show definite organization and structure in their chartered course. I mean, you can argue on a 5-minute chart or 10-minute chart or some people like the 3-minute chart or the 1-minute chart, or I think TradeStation and some platforms offer like a 30-second chart. OMG. But you can argue that on a really short time frame, there's a lot of randomness and emotion, but you get to the 60 or the 120 or the 480 or the 240 and above, there's a rhyme and reason for what they're doing. Okay. During an uptrend, we want to buy long, pullbacks, retracements to uptrend lines to join the uptrend. As close as you can get to a 3-touch trend line, you want to go long. And if you're buying a pullback to an uptrend line, your sell stop goes a little south of the trend line. On a 60-minute trend line on the S&P, it might be 3.5 or 5 points. On a 480 chart, it might be 6 or 8 points. But risk is always going to be commensurate with reward, right? So on a higher time frame, trend line break, you might have to risk 10 points on the S&P or micro, but your reward is going to be 30 or 40, right? During a downtrend, you want to sell short rallies back to the downtrend lines to join the downtrend. Join the trend. There's also trading ranges or non-trending markets. You can define that sometimes you get a trading range and S&Ps go into a 60-point trading range for 3 or 4 days. And you buy the low and sell the high many, many times. Or NASDAQ might go into 120 or 140-point trading range for a couple days or a week or two, and then break out and go into a trend. The markets like to go from being balanced to imbalance back to balance, or low volatility to high volatility back to low volatility. And good traders position themselves during the balance period or the low volatile period before the market starts trending and breaking out. So the earlier you get on board, the better, obviously. All right, so 3 major applications for using trend lines as part of your strategy. How do we use them? Number 1, to lock in profits on existing trades or investments by using sell-stop orders below the trend line on the daily or weekly time frame. Like when Netflix had that, there was the strongest stock of like 2021 or so, and then it dropped like 80%. Well, a really bad trader would, be up. Let's say you're up $10,000 on Netflix. You don't take any money off the table, and then you only make $1,500 on it or $2,000. That's crazy. But if you would have put in a sell stop below the trend line on the weekly or daily time frame, you would have locked in 6 or 7 or 8 grand and not let all those big profits become much smaller. Okay, so that's how you can use them. Number 1. Number 2, to locate favorable locations on a chart to join an existing trend using the 3-touch confirmation strategy. And then number 3, to help recognize when the current trend is ending and a new trend forms in the opposite or reverse direction, trend line violations or trend line breaks. So those are the 3 ways we're going to use them. Here's a good slide to help you recognize a higher high and higher low in the upper left. Upper right, a little trend line break violation. Sometimes you get the trend line break in the retest. And then lower left, it's a downtrend. 3 lower highs, 3 touches. Join the trend on that 3rd touch. Don't wait for the 4th touch. The 3rd touch is the signal. And then here's a trend line break to the upside on the lower right. There's again, do they all work? Of course not, but a lot of them do. And a lot of them are 4, 5, 6, 7 to 1 risk reward ratios, especially on the intermediate and higher time frames. So take a screenshot of that or draw your own out. But this is trend line trading 101 right there. All right. So if you haven't heard of the Trading Turtles with Richard Dennis Turtles, Google it. There's an article from Richard Dennis in 1989. Also, the Market Wizards, folks. Some of you have already read a couple books. Jack Schwager's got about 5 or 6 books, all interviewing hedge fund traders, floor traders, screen-based traders, institutional traders. Richard Dennis's Turtle Traders all used trend following, and all the Market Wizards, excuse me, not all the Market Wizards, but a good majority of the Market Wizards discussed trend following. Okay, not MACD, not stochastics, not relative strength, not divergence, not Fibonacci, trend following, price action. That's it. You can use 1 or 2 of those things for confirmation. I'm not here to, shame MACD or Fibonacci, right? But though a lot of people use those in conjunction with trend following or some other price action based strategy. Andrew, Dan, do we need to use the pivots or just connect 2, 3 wicks or more trend lines? Well, you start with the swing higher low pivot. That's the first, that's the first touch. For an uptrend, after the market drops nicely and you get that nice little bounce, watch that first low. And then if you have a higher low, you get the first drop, you rally, then you drop again a little bit, but you don't take out that first low. Then you have a higher low, draw that trend line and look for that third touch. Now you're ready for it, anticipating, right? Or if it's a downtrend, you get that rally, spike high, and then you get a little drop, and then you make a lower high. Draw that downtrend line off the first 2 touches. Now you can see visually when and where, if you get that third touch. Sometimes you don't get that third touch. But yeah, so good question. Just use the pivots or the swings. The major one is going to be the touch number 1. And then if you have a higher low or a lower high, that's touch number 2. And then you wait for touch number 3 to join the trend. Trend line break, you're just waiting for the trend line break. So use that high, low. Yeah, exactly. Yep. So again, all the turtle traders and more than half majority of Market Wizards used some sort of trend following in their methodology. So let me, I wanted to put a quick link in there. I like to trust but verify. A link to my testimonials, right? I have a little social proof. I'll put that in the link there for you folks. Copy and put that in there. So here's a little document for my testimony. I got over 750 or 1,000 testimonials. You guys can take a look at that. I believe in trust but verify. There's my Facebook page, and then there's my ebook. So here's my little summer market summit special. I did a 5-hour masterclass several months ago. It's 2 sessions. Each one's about 2.5 hours on Zoom. 5-hour masterclass going over trend lines, how to draw trend lines, trend following, identifying the macro trend, how to draw trend lines accurately. A lot of students will say to me, Dan, they look great, whatever, but trend lines can be very subjective. And my answer is, if you don't know how to draw them, they can be very subjective. But when you know how to draw them, they're actually very objective. It's either there or not. So it takes time to develop the skill, but when you know how to draw them correctly, they're very objective. And then I go over 5 very reliable chart patterns, which are bull and bear flags, ascending and descending triangles, and the wedge, or some people call them symmetrical triangle. There's a lot of patterns out there. Those are my 5 favorites. They generate a lot of good low risk, above average reward, above average probability opportunities. Again, bull and bear flags, ascending and descending triangles, and the wedge or symmetrical triangle. I talk about position sizing, risk management, and psychology in those 5 hours. You also get a 1-hour live consulting session with me, 101, and you get to keep the Zoom recording. I want to make sure you get it and understand it. So you get to keep that recording, and you can schedule that anytime, 2 days after you're done, or you want to wait a month and a half. It's up to you. You schedule it when you want to. I'll give you the free ebook, and that's normally $45. Normally I charge $875 for all that. I'm knocking off $250 for this summer market special. There's the link for it. So $625 for the 5-hour masterclass, 1 hour live consulting, which is recorded, so you get to keep it, and my free ebook. All right. How about we dive into some charts and look at some trend lines? And I can even, you guys can type in a symbol. I don't want you to think I'm cherry picking nothing, because I'm an honest, straight shooter from Chicago. You can tell my Midwestern accent, but I'll do a couple. Then you guys can type in any symbol you want, and I'll pull it up. You know, I got this from a student a couple of years ago. There's a lady looking at her birthday or Valentine's Day with love in her eyes, and he's looking at that crude oil trendline break for $5, risking 60 cents. So little humor there. So all right, let me pull up e-signal. That's my this is what I'm using today here. So let me show you the trend line break on the NASDAQ yesterday. Looks like they're up pretty good. They're up 0.75% today, and S&Ps are only up 0.2. But here's the trend line break on the NASDAQ. If we're up here, look down and to the left, grab that swing lower pivot. It should jump out at you like a sore thumb, right? Once you get your eyes trained, you look down and to the left, grab that swing low right here, and then connect the lows. And yes, what's today? Thursday. So Tuesday night futures opened up right here at the trend line. Tuesday night rallied a little bit. There's a great double top, folks. Repeat after me. Price has memory. That'll serve you well, folks. Double tops and double bottoms work a lot. Double top there, give or take a couple points. And then Wednesday, after the opening, we broke the trend. This is actually a 2-touch trend line break. So the rule is 3 touches to confirm an uptrend and join that uptrend after you get the 3rd touch. As you can see, sometimes a 2-touch trend line break, it doesn't hold the 3rd touch, and it goes through it like a knife through margarine. But that's a 300-point break, folks. That's over a 300-point move on 30 points of risk, 40 points of risk on a micro NASDAQ or big NQ. It also broke the 480 time frame. Let me show you the 480 chart on the NASDAQ as well. Here's the 480 chart. We've got a parabolic rally for a while. Market looking a little frothy. NASDAQ is more sensitive to rising rates, lower bond prices than the S&P for several reasons. But there's a trend line break. Notice how I got rid of one little low here, folks. Here's a little extra nugget, folks. When you've been in front of the screen since 1996, like I have, you see little nuances. I'll get rid of 1 or 2 anomalies. I'm not going to get rid of 3 or 4 and, curve fit or try to make it fit. But if I see 1 or 2 anomalies, because those wicks are emotional spikes. The ones below the candle are fear. The ones above the body are greed. So if I can get 3 or 4 touches and I disregard 1 little wick anomaly, I'll get short at a higher level. Some people are purists and don't do that, and they'll draw their trend line like that. That's fine. I'll get short at 15 or 20 points higher than they do. Doesn't always work my way when I do that little 1 or 2 candle cheat, if you will, but I've noticed it works a lot. So this one's a good example. So again, that's a little nuance on it, but 1, 2, 3, 4, that 5th one broke 30 or 40 points. Then it went back up. You may have taken that TLB. You got stopped out. Okay. There's one that didn't work. And then the second one worked for bad mamma jamma, 300 points, 14,585. And look where the market stopped going down, folks. Look where the market stopped going down. You don't think price has memory? Double bottom. That low was 14,248 quarter, 14,256. 8 points separated that low. And then as Vince mentioned in the prior session, look down to the left. There's nothing to support this market. I mean, I would have had a little demand right there with this little triple bottom there. I'd watch that level, but we pierced it pretty easily, right? So you might have T1 right there. I like having a scaling out strategy. I scale into trades, and I scale out of trades, T1, T2, and T3. So We may have gotten short in here. Here's T1, because we could have stopped there and bounced back up. And then T2, there was nothing in here to stop it. And then look where we bounced, 14,250 to 14,440. There's a TLB on the 480 chart. Quick look at the S&P. Again, if you guys want to type in a stock or a futures contract just to take a look at it right now, Tesla, NVIDIA, whatever you want. Where's the S&P on the 4-hour chart? Here's the 4-hour chart yesterday. We had a nice wedge breakout to the upside. There's a wedge breakout, right? You like those wedges? My daughter said, Daddy, I got a wedgie. We can take a look at Cat in a minute there, Oliver, you bet. So here's the lower highs meets higher lows. Look at that, folks. Uptrend line. I want to introduce you to the downtrend line. The market gets tighter and tighter, and then bam, inertia breakout. Do they all work? Of course not. But this one went from 42.93 to 43.04. 12, 13 points in a couple hours, straight up, never down money. Wedge breakout. I like to use that old Boolean. Some of you programmers or engineers have heard of that Boolean phrase, if this, then that, right? If the market goes here, I want to be long. If the market goes here, I want to be short. So if this, then that works out well in trading. So it was a couple hour. There's your double top in the SPOO, 43.0575 on June 5th, 43.0475. 1.4 ticks separated that high. We had some early strength yesterday and then reversed, and then somewhere between 10:15, 10:30, we broke the uptrend line around 85, 84, and went down to 69 pretty quickly. 15 points, pretty much straight down. Okay, that's the 240. Gold's had some wicked trend line breaks, but I got 3.5 minutes here. Caterpillar, let me go new chart, and let me go Caterpillar, $CAT. Caterpillar, big agricultural, industrial. Let's take a look at the weekly real quick. That big picture, Caterpillar, okay? Let me just throw on some trend lines here real quick. Boom, boom, boom. So here's a good example. This particular one only worked for about 248 to 234, $14, and then it went back up. But the risk was $1.50 or $2. It went $14, went back up. Now you draw a new trend line off the same pivot, and the second one worked a lot better. And Doc was there's your lower high. There's your peak. You drop, you get a lower high. Now you draw the downtrend line. Once you get that lower high. And some of you that have been around the game for a while, we call that an ABC top or a 1, 2, 3. 1, 2, 3 ABC. It's like that Michael Jackson song. 1, 2, 3, and we go down, or A top, B pullback, C retracement, and we make a lower high. Simple, right? ABC 1, 2, 3 stuff. But there's Caterpillar, and there was a great trend line break to the upside, Oliver, right there, baby, 2 weeks ago. Oh, and you know what else is that, guys? Doc, I'm putting the pressure on you. You've taken my class in Arizona, Doc. What's that right there? And anybody else let me scroll through the names here while you guys are thinking about that. Anybody else I recognize in here? What pattern is that, Doc? Or anybody else? Anybody? First 3 correct answers get a mocha latte, Starbucks from the Sugar Cyber Cafe. Ascending triangle, folks. Ascending triangle, the same lows with the lower highs. Ascending triangle, the same floor with the trend line right there. Once you get above it, this trend line broke around 215, 216. This week's high is 236. There's a $20 rally, folks. Great call, Oliver. Great Caterpillar on a weekly chart. We got above 216. It's a $20 rally in a week and a half. On where does your stop go? You always want to know where your risk is, and I'll end it. You're long at 215.50 or 216. Your stop's around 211, 210.50. So about $4 or $5 of risk. It's gone, like I said, 215 to 236. It's gone $19 already on $4 of risk. and you're not done yet. So there's a couple trend lines down there. Here's a nice TLB. Markets take the stairs up and the elevator down. Sometimes it's the express elevator. Well, it's descending because you have lower highs with the same floor here, right? Sometimes the floor gives, other times the floor holds, and either way you're going long there or short there. If this, then that, right? You get above the downtrend line, you're going long. If the floor gives, you go short. Your stop is above the floor a little bit. Okay, folks, I was under a lot of pressure to get down at 10:59 and 45 seconds. I think we did it. Okay, well, either way, it's a great pattern, several trend lines, but thanks so much, John and Rod. I appreciate it. Keep me in mind for the next one in a couple months. I love doing it. Hope you guys got a lot of information out of it, taking some screenshots. Say hello, Bear. Here's my Bernedoodle. He knows when I'm wrapping things up. My big Bernedoodle, 85. He can sense in my voice when I'm about to wrap things up. So I hope you got a lot out of it. I hope to see you in my masterclass and the consulting. We look forward to the next one, folks. Dan's the man. Thanks, everybody. You're welcome.
We dropped a link in the chat over there, guys, and that is kind of cool that the dog recognized your tone and he was like, "Oh, it's time for me now, right?"
They're sharp. I got a Yogi, 25 pounds, Bear's 85, but he can sense when I'm wrapping things up, and then he gets up the floor and comes in and
it's his time. He knows. He's like, Dad's busy until this moment right here, and then it's time for me.
Smart puppies. We underestimate them.
Yep. That was actually a really great talk. And by the way, a slightly off topic, something about you presenting everything, Chicago accent, bull and bear. As a sports fan, it's the first time it's ever occurred to me that the teams are the Bulls and the Bears.
Right. Was that coincidence, or was George Halas and the original Bulls owner, would they plan it that way? But that is a good coincidence, right?
It never occurred to me. You just said something earlier, and I was like, oh, wow, how did that not ever? I'm like, I'm literally a sports addict. How did that never actually pop in my head until you just said it? So,
and remember, the last thing I'll leave you with: Bulls and Bears make money, hogs get slaughtered. Don't be greedy.
Boom. I love that.
Use your trend lines, use your stops to lock in some profits.
Even if
you get out and it keeps going your way, okay, big whoop. Let your winners run, but you got to take a profit, right? Nobody ever went broke taking profits. So Bulls and Bears make money, hogs get slaughtered.
Love it. Listen, guys, like I say, everyone that we listen to along the way, we just need to find one or two little nuggets that we walk away with. I think the first two speakers have given us like almost a day's worth. So I really want to thank you one more time, Dan, for coming out. This was actually really good. I had a feeling it was going to be when we met on that call. I was like, I had a feeling this is because this is too easy for you, but there's a link in the side over there, guys, in the chat. Please jump in. 5-hour masterclass, 1 hour. By the way, I want to ask you one question before you go. That 1 hour of live consulting, that's just you and me one-on-one?
Yeah, one-on-one live consulting. One-on-one.
Oh, wow.
And it's recorded. And usually
that's
like $500 an hour for consulting, but
yeah, that's actually got a lot of value to it right there. I'm not sure we can possibly get all the knowledge you have in an hour, but you could touch on some good stuff.
After they watch the masterclass, write down a bunch of questions. I want to make sure they get